Good afternoon, everyone. I'm Marty Coughlin. I served as the SAIA president from 2012 to 2014. I am pleased to introduce one of the most anticipated presentations of our annual convention, the Economic Outlook. Ken Simonson serves as the chief economist for the Association of General Contractors, otherwise known as AGC, and is widely recognized as one of the construction industry's leading economic experts. He regularly provides analysis and insight on construction spending, labor markets, workforce availability, material pricing, supply chains, and the broader economic trends affecting contractors across the country. Please join me in welcoming Ken Simonson.
Well, thanks, Marty. It's great to be back here and to be able to bring at least some good news. It's certainly a mixed picture. Let me start by talking about construction employment and then move into what's happening with different segments of the industry, materials costs, tariffs, the Middle East conflict, and finally, my own outlook for where we're headed next. For those of you not familiar with Associated General Contractors of America, we're the leading construction trade association representing over 28,000 companies, general contractors, specialty trade contractors, and suppliers of equipment, goods, and services like many of you. And our membership belongs through one or more of 87 local and state chapters. So I hope that if you have not yet been in touch with an AGC chapter, that you will look at agc.org, see where the nearest chapter is, and contact them. I think you'll find the information and the contacts there very valuable. Enough of the advertising. Let me get into the core of this. This slide shows what's happened to construction employment compared to total national payroll, non-farm payroll employment, that headline figure that you hear about on the first Friday of each month. And the total non-farm figure is the line in green. These are all year-over-year changes. They start back in 2023 when you can see that employment growth was at a strong 3% rate. It's tapered off significantly, still positive, but only 0.3% in the last 12-month period. The black slide shows the change in total construction employment, which has generally outpaced growth in total non-farm employment. But there are two big differences, two big segments within construction. On the residential side, that is home builders and residential specialty trade contractors, employment has been declining quite sharply over the last year plus. Non-residential construction employment, shown by the red line, comprises the employees of non-residential building contractors, heavy and civil engineering firms, and specialty trade contractors. And you can see that employment, while it's slowed down, has actually been gathering speed over the last several months. So the outlook really depends on what part of construction you're focusing on. And I think most, if not all of you, are on that good red side of the line. It varies a lot by state also. This map shows the change in construction employment from May of last year to May of this year. 30 states had an increase, but 18 states had a decrease in construction employment in that time. Generally, the weakness was along the West Coast. We've been seeing that for quite a while. Some of the Northeast states, although some of them have pulled out of the hole. But more recently, some of the Southeast states have also hit the pause button. Broadly speaking, the strongest growth has been across the center of the country, from east to west as far as Nevada, and up the center of the country, from Texas into the Dakotas and Minnesota. We get another measure of what's going on with construction employment about a month after the employment report itself comes out. It's a series called Job Openings and Labor Turnover Survey, or JOLTS, my favorite acronym for a government data series. And here, instead of plotting the year-over-year change, I'm showing the level of, or the rate, I should say, of these series as a percentage of employment in a given month, in this case May, in each of the 26 years history of this series. So starting with hires, the industry hired only 3.5% of its then workforce in May of this year. If you trace back across the history of that line, it's by far the lowest rate of hiring in May in the whole 26-year history. Job openings, shown by the blue line, that rate did pick up a little bit, but again, the last 2 years, May rates have been the lowest in a decade. So this fits that broader story of a low hire environment. But look at the gold line, layoffs. That's also running at a very low rate. So that's the low fire part of the story. And if you go back to 2008, 2011, when we had the housing collapse and then the global financial crisis, that was the last time we saw a huge drop in hiring and in job openings. And at that time, firms were laying off people just to keep the doors open. They didn't expect to need workers. They knew, expected the business would not pick up, and that was the case for quite a few years. This time, the fact that layoffs are staying so low indicates a degree of optimism, but also a recognition of how hard it will be to fill jobs if they let employees go. Turning now to spending, the black line here shows total construction spending has also been on a downward growth path. In fact, has turned negative over the last year. Again, these are year-over-year changes, and in this case, starting 2 years ago, the year ending in May 2024, when growth was almost 10%. Now it's down to a negative change in recent months. But again, there's different stories to tell within this data. These come from the Census Bureau's monthly press release. They'll be putting out the June figures on next Monday. And what you see here is that the red line, in this case, private non-residential construction spending, deeply negative, has been for well over a year. Private residential spending, shown by the blue line, was also negative. It's picked up recently, but there is an asterisk on that, which I'll get to. Public construction had been holding up quite well until recently, but as state and local governments run into more financial problems with the federal government no longer sending along buckets of money following the pandemic, that side of spending has also tapered off and recently been negative or close to zero. Well, that comes from the Census press release. You have to go to their website, census.gov/construction spending, and see 4 Excel files of historical data. The one showing private construction, these files among them show information about 170 kinds of non-residential projects. And the private historical data file shows that data centers, which are buried in the office category, data centers have had this incredible growth. In fact, the latest figure, 23% through May, was actually down from as much as an 80% growth rate a year or so ago. So the compound rate of growth on data centers is just staggering. In fact, over the 6 years since January of 2020, data center growth has been up 500%. If you take data centers out of the office category, it turns out, and nobody's surprised by this, that private investment in office investment, construction investment, is actually down 12% in the last 12 months, down 35% over that 6.5-year period. In fact, all private non-residential construction minus data centers is negative. Well, here's some more detail on what's been going on in public and private categories. So starting at the top, Total construction spending in this latest 12 months through May was down 1.5%. Residential was up a little bit, but within that, you see that, in fact, private single-family still down by 4%, multifamily up for the first time in quite a while. It's had a huge drop-off until recently. But the real growth is in what census classifies as residential improvements. That's additions and renovations to existing owner-occupied housing. And I think that is a sign of how many people are stuck in their homes rather than going out and buying a new home or changing location, buying somebody else's home. Just this morning, we heard from Freddie Mac that the 30-year fixed mortgage rate was up to 6.66%, the highest in a year. So that is keeping people who got those sweet 3% mortgages a few years ago locked into their homes, even when they may prefer to go to another location or another type of home. And it's also certainly pricing out would-be first-time home buyers. So I think the outlook for single-family remains weak for both the outlook for residential weak for both single-family and multifamily through the end of the year, although multifamily will have some markets where more people are moving into apartments. The real growth will continue to be in the improvements as people who stay in their homes adapt them or add to them, upgrade them. Turning now to the non-residential side, we see that total public and private combined was down a pretty steep 3.8%. Private down 6.6% over the year, public up just a hair, 0.3%. And I should add, these are not adjusted for inflation. We don't have a single measure that captures the units of non-residential construction when it ranges from anywhere to small retail to giant infrastructure projects. But if we could do that, we would certainly see decline. In fact, we do get a separate measure of that from the Bureau of Economic Analysis as part of its quarterly gross domestic product estimates. Those figures are adjusted for inflation, and they reported today that non-residential structures investment, private structures investment, was down again for, I think, the 12th straight quarter, down at about a 5% rate. For the first time since the beginning of 2024, residential investment was up a little bit, but unlike what you see here with single down and multi up, it was the reverse. Nevertheless, weakness pretty much across the board once you adjust for inflation. Well, looking at the rest of the table, it shows the non-residential categories as defined by the Census Bureau in descending order of May 2026 size, and within those categories are subcategories also in descending order. So the largest by far had been manufacturing, but manufacturing construction. But construction of semiconductor fabs, of EV and battery plants for EVs have tumbled in the last year. So now manufacturing and power are just equal, both 175 billion at what we call a seasonally adjusted annual rate. I do think manufacturing is about to snap back. For instance, in Phoenix, TSMC, which had finished up a giant fab, is now starting on another one. Intel, which had run into deep financial trouble and hit the pause button on its projects outside of Columbus, they're doing much better. And Micron, which has been talking about building a huge complex in mid-state New York near Syracuse, that is actually starting work now. So the upturn, I think, is going to come back on that biggest category, what Census calls computer, electronic, electric manufacturing. In addition, the chemical category, which is just about flat in this particular period, is going to benefit from huge pharmaceutical projects going on in North Carolina principally, but several other states, Indiana, New Jersey, Pennsylvania. And then at the other extreme of chemical manufacturing, giant natural gas liquefaction trains. I was down in Baton Rouge yesterday, and they were talking about a huge project going on in Cameron Parish around Lake St. Charles, around St. Charles, and on the Texas side of the Sabine River, also getting projects there and on down the Texas Gulf Coast. With the huge global demand for natural gas, I think we will see even more players get into building those kinds of facilities. Power also looks like a strong category. While the Trump administration has done all it can to discourage or block wind power and certainly has been opposed to solar, the demand for solar remains very strong. Data centers are now being forced to look for power sources that they can build themselves or control behind the meter. That is, they're not going to be added into everybody's rate base. And beyond that, the utilities are belatedly realizing that they need to do a lot more investment, both in generating, transmission, local distribution, and battery storage. So battery storage counts as part of power construction, and it's a large bucket within that category, both at data centers, other mission-critical sites, and utility sites. Highway and street construction has a somewhat hazardous future in that a large part of the funding comes from the Federal Highway and Transit Authorization Bill, which must be renewed every 5 years. The current bill is expiring at the end of September. I was in Baton Rouge yesterday in order to plump up interest in getting Congress to pass the replacement bill by September 30th. It just happens. We didn't pick it accidentally. We chose Baton Rouge for two reasons. It had the largest percentage gain in construction employment out of 360 metro areas from June of last year to June of this year, up a whopping 22%, or 10,200 jobs. That was more jobs added than any other metro area except Houston and St. Louis. Both good deal bigger metros than Baton Rouge. But the other reason we chose Louisiana was, of course, that the Speaker, Mike Johnson, and the House Majority Leader, Steve Scalise, are from Louisiana, and we want to rile up voters in that state to let them know how important getting a new highway funding bill is. In fact, I was standing in front of part of the very long-running I-10 reconstruction and widening project as an example of something that might take even longer if Congress fails to act in time. However, I'm not very optimistic. There are only a few days that Congress is going to be back in session. The House Transportation and Infrastructure Committee did pass a bill, but it has not been taken up on the floor. Senate committees have not acted at all yet. So I think realistically it's going to be this time next year when House and Senate are heading for recess, or even September 30th of next year, before we get a 5-year extension. My best hope at this point is that they will adopt a series of continuing resolutions, popularly known as kicking the can down the road, but at least keeping the funding flowing at current rates. Educational construction, at the moment you can see a small decline in primary, secondary, bigger decline in higher education construction. The category as a whole is positive because of a grab bag of separate projects, such as the Obama library that opened just a month or two ago, other museums and libraries, archives, special educational institutions. But I think the outlook is getting quite grim for educational structures. We've seen for a number of years that the number of college enrollments is declining. That's partly because we hit the peak in births 18 years ago, and it's a steady decline for the next 17 years, and who knows after that. But that means fewer potential college entrants, fewer entrants to the workforce if they choose not to go to college, and now immigration visas for foreign students and faculty have been cut. Some are being detained, booted out of the country, and those are students who were typically full pay and made the difference between a college operating in the red or the black. So we've seen an increasing number of colleges closing their doors, universities lopping off departments. In any case, much less need or demand funding available for new structures or even for reconstruction or updating of older ones. That same baby bust is going to show up in more and more school districts also. The Wall Street Journal had an article about that this week. And I think we will see more school closings. School districts will still be putting money into building new facilities. In the South, a lot of stadiums, but also classrooms and other facilities. But nevertheless, not the same rate of growth that we had when the school-age population was growing. Commercial construction is a mix of warehouse, retail, and farm construction. Warehouse construction was in steep decline. I think it's close to bottoming out. We are seeing some of those last mile, last hour, even last half hour delivery points being set up inside metro areas. And also specialized warehouses to serve the needs of data center construction and other selected niches. So warehouse construction, I would say, likely to decline, but not as much as it had been. And then retail really depends, as always, on where you are. So there certainly are some suburbs, some neighborhoods where retail is doing well, but the downtown area is extremely poor. Again, retail likely to stay close to zero. Office, I talked about how misleading the census press release figure is with that gain of 4%. It's really made up of data centers up 23%, private office down 12%, public office also starting to decline. Healthcare, 3 segments at the moment. Hospital up, I think I have a typo here, medical building, special care. I don't believe they were both down that much, but at any rate, I think the growth will be outside of a hospital setting. We're seeing a lot of hospital closures. Just yesterday, the administration announced that it was reducing federal funding for some types of patients or care, and instead, more care is going to be delivered outside of a hospital where the costs are generally lower, but also as more of the population ages, needs specialized care, more and more, we're going to purpose-built facilities for those. Transportation. Airports everywhere, still doing a lot of construction. I think that growth is likely to slow from what we've seen in the last few years, but remain positive. But transit, even if we do get a new federal bill in time, I think will continue to suffer from a hostile or indifferent administration in Congress. Well, across the bottom, I've squeezed the other 8 categories census talks about. Be glad to take questions about that at the end, or have you email me if you prefer. Let me move on to what's happening on the cost side. This shows some of the producer price indexes, excuse me, that BLS puts out around the middle of each month. One that I pay particular attention to is called the Producer Price Index for inputs to new non-residential construction. That's a weighted average of the cost of all materials and some services, such as design and trucking services, that go toward non-residential projects. And you can see that from May of last year to May of this year, those prices went up 8.4%. That was twice as much as the Consumer Price Index, which went up 4.2%. And within the PPI for inputs to construction, there are some even more extreme examples. Diesel fuel, these are from domestic producers or first sellers. So diesel fuel at the terminal rack or the import terminal or the refinery more than doubled, 106%. It did come down some in June, but just lately has gone back up again. And then aluminum mill shapes are being hit in two ways. A 50% tariff that went on in June of last year, but also the production facilities in the Middle East and Iran have been damaged, and of course shipping has been cut off completely. So that has tightened the supply of aluminum. Copper, products containing copper were subjected to a 50% tariff last August, and steel mill products subject to a 50% tariff since June of last year. Now, all of these have gone through some adjustments. When I spoke to this group a year ago, people thought, okay, we've seen the worst on tariffs, they're just going to be what they are. No such thing. We have continued to see adjustments, sometimes very abrupt, on tariffs. So, for instance, just last Monday, President Trump slapped 50% tariffs on a number of things from Canada, including cement and a few other construction-related products. He also had to, the tariffs that he put on when the Supreme Court invalidated the first round of tariffs in April of last year, he immediately put on a new set of 10% tariffs on a whole range of countries. Those expired on Friday, but on Thursday, the U.S. Trade Representative's office announced that new tariffs of 10% or even 12.5% were going to be imposed on 80 countries immediately. So we still have a lot of tariffs, a lot of complexity connected to those tariffs. Some of you may be wondering, when are you going to get the refunds that the Supreme Court cleared on those illegal tariffs from a year ago? Well, the answer depends on whether you were yourselves an importer of record or at least were able to break out tariffs in that bill of sale. If not, you don't have standing, you don't have the chance to apply directly for the refunds. It's up to the importer, the seller, to you, whether they're going to pass that on. In any case, look at agc.org's Tariff Resource Center for Contractors for up-to-the-day information and all the nuance that I can't get into now and probably would get wrong if I tried to. At any rate, I think we're in for still more changes. There are a bunch of investigations going on relating to specific steel products or products containing steel, equipment, machinery, and so forth. And the expectation is that the Commerce Department will be putting on anti-dumping, countervailing duties that will raise the cost of those imports perhaps within the next few months. How about pay? Well, we have three measures of that. Every month, as part of the National Employment Report, BLS reports on a series called Average Hourly Earnings for Production and Non-Supervisory Employees. That's a long-winded way of describing the pay for most craft workers and office workers who aren't supervisors. And you can see that in the June to June period, that went up 4.8%. Whereas for the total private sector, production worker pay has been cooling off steadily, still going up, but only a little less than 3.5%. So this is kind of a good news, bad news story. It means that construction firms have been able to attract and retain workers more than other sectors, as I showed you in that very first slide, but it also is another cost that contractors will either have to swallow, make up through productivity gains, or pass on. Two other private sector measures. AGC is one of a dozen associations that support the Construction Labor Research Council. They analyze all union settlements in construction, and they reported recently on the first half of this year, not shown on this slide, that contracts had a first-year settlement, that's wages and benefits, of 4.9%. That replaced contracts expiring that were negotiated 3 or 4 years ago with 2 to 3% increases or perhaps first-year freezes. So definitely a big jump there. And then the firm PAS, for over 45 years, has surveyed construction firms about salaries. And they found that early this year, firms were expecting to raise pay by 3.9%, but they said that historically, those early year estimates turn out to be anywhere from 3 to 0.5% low. So whichever of these measures you look at seems to be pointing to pay going up another 4 to 5% this year for construction, again, outpacing the broader private sector. Well, one thing that can be very important to construction firms is what's happening on immigration and deportations. That's because, according to an analysis done at the Harvard Joint Center on Housing Studies and also by an economist at the National Association of Home Builders, construction craft workers, 35% of them are foreign-born. That's double the percentage throughout the whole workforce. Now, it varies hugely by occupation. So the building envelope trades, floor, carpet, wall, insulation, ceiling, roof, 50% or more of those workers are immigrants. Whereas for construction equipment operators, structural iron and steel workers, some of the professions that you engage with, those percentages may actually be lower than the all-industry average. It also varies hugely by location. The states in deep green, starting with Texas, 53% foreign-born, Florida and California, 52%, Maryland, 51%, Nevada, 50%, other states in medium green, such as Georgia and Virginia, New York, also well above, more than double the national rate. The states in bright red, close to the Canadian border, understandably very low single-digit percentages in are foreign-born. How has the Middle East conflict affected construction? How is it likely to? Well, the most immediate effect was on diesel fuel prices, not just for the thousands of gallons of fuel that contractors buy for their own trucks and off-road equipment, on-site equipment, but also for the thousands of deliveries of equipment, goods, and materials, and the taking away of dirt, debris, equipment at the end of a job. And we very quickly saw fuel surcharges coming back, still in place from what I hear. So far, natural gas prices in the U.S. have not gone up. They have gone up globally, so there is still the risk that you will see higher prices for things that use natural gas, either as a feedstock, such as, as a fuel, such as cement and glass, or as a feedstock, such as many construction plastics. In any case, energy costs are inherent in anything you buy for construction. For example, steel clearly takes a huge amount of energy to heat and to shape and even to deliver it and to erect it. I mentioned alumina being under threat from the cutoff of supplies from the Middle East. Other materials, so far I have not heard of supply chain problems, but I think the risk of that is growing. And then for investors, many had been trying to get investment from sovereign wealth funds, rich families and individuals in the Middle East. And more they're going to be either finding they no longer have that source of income because of destruction and cutoff of exports, or they're turning inward to rebuild their own countries. What are the policies now in effect that are affecting construction? I talked about tariffs, how they hit construction more than other sectors, but they certainly affect owners too. So I've been hearing for a year and a half now about owners hesitating to go ahead, partly because of tariffs. They just don't know what their costs will be, what the competitive situation will be with foreign firms that aren't facing tariffs, and the markets they're trying to export to, outright discrimination, as we saw when the Prime Minister of Ontario pulled U.S. wine and liquor and beer off shelves there. Then other kinds of businesses also are being affected by tariffs on their costs. And that feeds back to more hesitation, scaling back, or cancellation of projects. The immigration and deportation policies, again, construction affected more heavily than others, but it has also meant that with the closing of the southern border, it's getting harder for any industry to find replacement workers as other workers retire or immigrants who are already in the country decide it's not safe to show up at visible job sites. And with the closing of the border, many cities, particularly in border regions that had seen population growth because of immigrants, suddenly they are looking at vacancies and perhaps declining population, declining tax base. So another bad sign for demand for construction. The deficits have kept long-term Treasury rates now at a one-year high recently, and actually going recently to a multi-year high, and that affects not just that 30-year fixed mortgage rate, but municipal bond issuers, state and local governments, private activity bond issuers at airports and hospitals and universities. And the more they have to put into paying interest costs, the less available for construction. We have seen tax rates stay low, but unless an owner sees a need for a project, sees that there will be customers for it, users for it, they're not going to go ahead even if they can expense a building instead of having to depreciate it. So to wrap up, I think the economy is still growing. The GDP report today showed that in the second quarter, real GDP, that is net of inflation, net of imports, grew 1.5%. That was down from 2.2% in the first quarter. But there were special factors that depressed that. We were importing more than we were exporting. Government spending also dropped. Inventories declined. If you look instead at a category called real final purchases by businesses and individuals, that actually accelerated to a more than 3% rate. Consumers are spending like crazy. I don't think they will keep that pace up, but I do think we're pretty safely away from recession at this point. However, the report also showed that inflation remains significant, and yesterday the Federal Open Market Committee declined to reduce its short-term interest rates. They didn't raise the target yet, but there's a lot of expectation that the next move on short-term rates will be higher rather than lower. Warehouse construction, as I said, may be bottoming out, but office construction staying very negative. Multifamily construction also may be about to turn the corner by the end of the year, but not yet. The best bets for growth are certainly data centers, power, still some growth for airports, and then some niches in specialty healthcare, and very small categories of warehouse and some other things, for instance, support for data centers. Manufacturing construction, big decline in the last year or more, about to turn from a bottom to climbing up again. I won't say it'll get back to record heights, but a lot of demand for production facilities to make things for data centers, for power, and now for defense contractors. Materials costs up certainly 3 to 5%, could go even higher as we saw in that May to May period. And the supply chain holding up well for now, but definitely something to keep an eye on. And labor costs up 4 to 5%. So that's my story. I'm sticking to it till I get new data. When I do, I'll put it in the Data Digest, my weekly summary of economic news relevant to construction. Try to get the next issue out tomorrow. If you'd like to subscribe, just email me at ken.simonson, S-I-M-O-N-S-O-N, agc.org, or get my card and give me yours. I'll send along an updated version of these slides also. But in any case, do look at agc.org. I think there are a lot of other resources there that you should find useful. So thanks for having me back, and have left a few minutes for questions if there's anyone bold enough to ask them of an economist in front of a room of your peers. But otherwise, by all means, feel free to email me. So thank you again.